Hello and welcome. I'm Simon Lewis, Chief Executive at AFME, and I'd like to welcome AFME SIFMA and ACIFMA members to today's briefing on ensuring operational readiness with your Brexit. We have a record number of participants registered, over 1,000, with the majority from the US, such is the interest in the issue we're going to discuss today. This is part of a series of webcasts on Brexit. In our last briefing in December, we focused on the political scenarios which could unfold as we get closer to the 29th of March, when the UK will leave the EU. Today, we still don't know where we are heading politically, and those scenarios are changing. What we do know is that faced with ongoing uncertainty, firms are continuing their preparations for Brexit. They are planning for the worst and hoping for the best. This webcast is therefore a timely opportunity to discuss the operational aspects which firms have to consider possible no-deal scenario. I'm delighted to be joined by Andrew Gray, who's the head of Brexit at PwC. 2 years ago, we published a report at PwC on the operational impacts and transformation challenge that Brexit poses for wholesale banks. We were ahead of the game. 2 years on, many of those challenges remain very relevant, and today provides a fitting moment to reflect on where we've come in this process, with just 66 days left until the UK is due to leave the European Union. I'm also joined by Galina Dimitrova, Director of Investment and Capital Markets of the Investment Association, the UK buy-side group. She will provide a valuable perspective from the buy-side industry. Oliver Moulin, who is Managing Director of Brexit at AFME, also joins us, and David McCarthy, Manager of International Policy at the Investment Association. There will be an opportunity at the end of this briefing for questions and answers. It's very easy to submit a question. All you have to do is click on the Q&A icon on the right-hand side of your screen at any time during the briefing and type in your question. Now, before handing over to Andrew, I would like to make a few remarks about the latest developments and where they leave us on Brexit. As you have seen last week, the UK Parliament overwhelmingly rejected the withdrawal agreement which had been agreed between the UK government and the EU. In the aftermath, Prime Minister Theresa May survived a motion of no confidence, but there remains very significant political uncertainty. Over the past few days, Prime Minister May has been speaking to representatives from across all parliamentary parties in an effort to win political support for an alternative. But so far, she does not appear to be prepared to forego any of the existing red lines. What is clear is that the Conservative Party and even the Cabinet are split on the way forward, with the UK Parliament increasingly seeking to influence the process. Yesterday, the Prime Minister confirmed that her plan B is to go back to Brussels to seek changes to the Irish backstop with a view to winning around the Eurosceptic wing of her party and the DUP, who ensures she has a majority government. A motion will be voted on next Tuesday to confirm the approach, and we've already seen amendments proposed which seek to give Parliament even greater control of the process. These are unprecedented times in UK politics. The question, of course, is whether an agreement is achievable in the time frame before 29th of March. There's an increasing chance the UK may ask for an extension of Article 50 to push back the exit day. Should the EU27 unanimously agree to such a delay, and they have to do that, this could move the UK's exit to the end of June, so before the European Parliament will begin its new term. There have also been rumours about a delay to December, although it seems unlikely the EU27 would agree to such a step without the prospect of a general election or a second referendum. Indeed, a second referendum is also gaining more traction, although the timing is quite significant. It remains the case, therefore, that unless there is agreement on an alternative deal, an extension or withdrawal of Article 50, the UK will leave the EU without a deal on 29th of March. In short, uncertainty is highly to continue, with numerous potential scenarios remaining. Faced with this continued uncertainty and the risk of the UK leaving on 29th of March without an agreement in place, member firms must be prepared for any Brexit scenario. On that note, and without further ado, I will now hand over to Andrew Gray to explain the challenges which financial services firms are facing to ensure day one readiness. Andrew.
Thank you. I think you've articulated very clearly some of the political challenge, and I think whilst we've been working on Brexit for over 2 years with our clients, the point that you highlight, which is that the ongoing political uncertainty is raising significant challenges. Many plans have been put in place, many firms have been investing for a considerable period of time to develop their Brexit strategies and have gone through significant cost in implementing some of those. In line with regulatory expectations, all firms have to plan for a hard Brexit with effect of the 29th of March 2019. But I think one of the features that many firms have been grappling with is the fact that they'd expected a degree of political certainty, so that probably by about now we would actually know whether it was going to be a hard Brexit by March or there would be a political agreement and therefore we would be moving into a transitionary period. So that represents a significant challenge because decision making and further cost is absolutely required by many firms, but without the lack of certainty about specifically what the end outcome is going to be. Just at a high level, many of our clients are reasonably well positioned in terms of having a clear view of location, a clear view of how they would operate, but they also recognise that they have got a lot of work to do in terms of the final implementation, which includes two critical areas. One is relocation of staff, so making sure that they are sufficiently robust in terms of their presence in the EU. In some cases that would mean recruitment, some cases that would mean further transfer of staff from London or other locations within the groups, but also in terms of their clients, making sure their clients are fully ready to actually transact with those new entities. And I'll come on to some more of those points in a bit more detail shortly. There's a final point, which is that firms need to have to be dealing with their regulators. The regulators themselves are actually in a very difficult position. They've been very clear with firms about planning for a no deal Brexit. But again, absent of some of the political agreements around this, I think we've seen some difficult conversations take place. Probably just move quickly on to some of the potential implications of what it might mean under the scenarios. And if we go to page 8, we'll just highlight a couple of those. And this is really is a challenge around if we have a no deal Brexit, then obviously firms will need to move into the plans that they start to execute on and finish moving people. I think we've sort of touched on some of the challenges around the people and some of the contract and client issues. But I think there are also some challenges in terms of making sure that all the components of market infrastructure, the fact that many clients will be seeking to move simultaneously, and potential implications on market liquidity, and the consequence of a simultaneous move of multiple firms at approximately the same point in time. And let's remember that this is not a voluntary move. This is a move which is a legal obligation. So unlike some previous significant changes that MiFID II, where there has been a degree of regulatory permission effectively to enable some of the implementation to take place after the formal deadline, transacting with clients that you don't have regulatory approval for is effectively a legal activity, and therefore it is absolutely critical that the business needs to be permissioned by a regulatory authority in the right way for that to occur. And we are aware of some firms where it's actually the regulator themselves, in some cases, from their bandwidth, which is causing some of the delays. If we do end up with a transition, that presents with so I guess a different sort of a problem. So if we have a deal either by the 29th of March, or if there's an extension to the Article 50 period, say to the 30th of June, we then get the deal, we then move into a transitional period. I think that represents some of the questions that firms are willing to answer. Specifically, some of the pressure in terms of migration of business will be taken away. Effectively, you can continue to transact business on the current basis for an extended period of time. That initially would go to the 31st of December 2020. But even then, there are some further options which will need to be explored. So the political commitment on future relations has highlighted the fact that equivalence determinations would be made by the 30th of June 2020. That statement was very clear that it was going to be looking at areas where there was existing equivalence provisions within legislation. So typically EMEA, MiFID II, which is specifically relevant to this industry. But that potentially could enable certain firms to conduct certain business on an extended basis for the foreseeable future, even after the end of the extended transitional period, on a basis where they can transact from the London entity into continental Europe. So again, it would adjust the way in which firms planning is looking. One of the things I think firms need to think very carefully about, though, is the fact that they will have all made commitments to regulators as part of their regulatory business plans, which effectively articulated the scale and nature of the business that they would put into their new EU entity, which has received a regulatory license. Now, in some cases, regulators have operate on the basis that if you don't use the license, they would remove it from you. So I think there is going to be a very difficult balancing act for firms relatively soon after the sort of start of business into a transitional period to determine the extent to which you use a license or the extent to which you try and retain business back in London, recognising that that might be the cost-effective way of doing business, but potentially increase further risks down the line. So very much a difficult balancing act that I think firms have got to try and navigate, and one which they will need further conversations with their regulators. Moving across to some of the risks around no deal, I'll come back to some of these. We've seen in terms of banking, absolutely 2019, only 60 something days away, is absolutely required to be ready. We're looking at, again, even without a deal, whether there might be some equivalent determinations at some point in the future, as yet uncertain, you certainly can rely on it. One specific risk which has been dealt with and comes through an equivalence is the roll around CCPs and CSDs. I think we were all really concerned in the run-up to Christmas that there was going to be a potential risk of some of the UK CCPs needing to issue termination notices. That would have created some quite significant issues for a number of firms. And fortunately, the European Commission and AFME, 19th of December, issued the emergency temporary equivalence determinations that will allow the ongoing provision of clearing to be provided on a cross-border basis. But that only exists until the 31st of December 2019. So in the grand scheme of things, a relatively short period of time, it removed the immediate cliff edge risk, but clearly there remains the cliff edge potentially in less than a year's time from now. Whilst the equivalence determination was issued around CCPs and CSDs, they did not also issue the equivalent determination for things such as venues. So exchanges and other venues aren't covered by that. So again, we run into a potential cliff edge risk towards the end of March when EU headquartered entities or EU entities may no longer be able to have full membership of exchanges. So again, specific issues and risks around that. So just moving on to, I guess, some of the broader range of risks on page 10 and the following two slides, we've identified where we see some of the specific challenges that exist at the moment. A couple of these, the top two I've already highlighted, which is around clearing and access to venues. One of the things that we did note when we were going around to some of our clients is that in many ways the operating model for the EU entity replicated much of what was the way in which business was done in the UK entity. So effectively replicating and assuming that all of the connectivity around market infrastructure could function in much the same way. That clearly isn't going to be possible, but again, it's somewhat uncertain as to the timing and nature of that, how that would unfold. There's also, I guess, a question mark around access to payment systems, around the euro, and also with regard to international currencies, so membership of CLS and how that would function. All of that, there are solutions for firms, but they quite often would be either more expensive or more complex to navigate, and in some cases they will require specific client permissions to do so. We talk about, the next point was around contract continuity. I think it's been fairly well documented that the actual specific event for hard Brexit wouldn't in itself result in contract terminations, although firms need to think very carefully about the wording within individual contracts, so clearly a comprehensive review of contracts is required. But the main risk that firms are experiencing, I guess, is around two aspects. One is the ongoing ability to service a contract through its life cycle, and the recognition that there may well be regulated activities or events that occur during the life cycle of a contract. If you wish to retain it on an existing entity, that will present some practical problems. The other point was around and linking to the preparedness of clients, so actually having clients migrate to new entities. We've seen a variety of different outcomes for firms as they've gone into those conversations. Some firms have experienced a lack of willingness or an appetite from clients to actually make the move to repaper to new EU entities. In some cases, that's because they are themselves rationalising banking relationships, perhaps. In some cases, they may well already be contracted into EU entities for other banking organisations. But also, as we go outside of financial services, when we've looked at the level of preparedness of clients in a whole range of industries, their own Brexit programmes are significantly behind, in many cases, the level of preparedness and maturity that we see in financial services. So in some cases, this is a reaction to the lack of preparedness that those organisations themselves have taken in terms of looking at Brexit. And often it's actually the financial services interactions. They believe that the industry, our industry, will actually solve the problem for them without themselves necessarily having taken sufficiently practical and proactive step on that. I'll just cover off a few of the other points quite quickly. I mean, you can read the slides. The slides will be made available through the AFME website, hopefully in the next day or two. But specific points that we are seeing firms grapple with: operational resilience and the increased operational complexity. Given the focus of operational resilience from the regulators, we see that as being a potential risk that firms need to take to address. There are specific issues around third country exposures and the potential relief that may be obtained that is consistent with existing treatment when the UK and the EU are effectively third countries to each other. Some of the relief you currently can rely on may not be available, and particularly for firms which effectively rely on contracts to be issued under the law of an EU country. Of course, the UK will no longer be in the EU and no longer be able to have that eligibility going forwards. Credit ratings, a specific point in terms of many new entities don't have a transaction history, they don't have a credit rating, so again, some firms may be reluctant to transact onto entities which don't yet have credit ratings. I'll probably just skip over the other slides and just look at, into the time, and some of the specific points that we are seeing the regulators respond to. And I think it's interesting to note the way in which both the UK regulators and the EU regulators have got different approaches. And it's certainly worthy of note in terms of just some of the specific points. I'll just touch very quickly on the UK regulators and then move on to the ECB. UK regulators have sought to introduce provisions as early as possible in the process, really focused on ensuring that they can have continuity of market access for firms. So this predominantly applies to those firms which are EU legal entities transacting into the UK, usually through branches, but sometimes in terms of providing services on a cross-border basis. The UK regulators have introduced a temporary permissions regime for those firms that have already submitted branch applications into the regulators. There is an automatic onboarding into that process. For other firms, they specifically need to apply for it. The application is online now. Firms can do it. We would encourage everyone to just revisit the level of information they're providing to the regulators, because one of the key things is that the temporary permissions will only apply to existing permissions and existing licenses you have. If you wish to change the business, then that would need to be a separate process around regulatory approval. The permissions under the TPR will operate for 3 years, so we'll have ample time for firms to adjust to whatever future regime is determined. The long-term regime is not yet clearly articulated. There are consultations around that, but we believe it is going to be broadly similar to the current third country branch regime that the PRA have already established and has operated for an extended period of time in the UK. There will be full onshoring of all EU regulation into the UK, which is going to make life more complicated for firms, because effectively that means you can have a UK version of MiFID II and an EU version of MiFID II. The rules and the way in which they're articulated in the first instance will be identical, which is a benefit to all firms who have now gone through an extended period of time implementing MiFID II, but effectively it will be a split regulatory process. So, for example, transaction reporting would be to the UK trade would be the FCA, EU trade would continue to be to ESMA. The other thing that we're certainly aware of is that the UK regulators are building out memorandums of understanding with EU regulators to assist in the medium term. Now, clearly, they won't sign until the UK formally becomes a third country, but we have got a reasonable expectation that the conversations are fairly mature in that, so as to provide a minimal disruption to firms on that specific point. In terms of the EU response, I've already touched on the clearing point, but what is also being clear, and the European Commission has made clear that as at the end of December, they believe they've made all the statements they need to make around emergency provisions that will be provided in the event of a no-deal Brexit. So effectively, we're not expecting any significant shift around that. I'd already highlighted the issue around clearing, and we do have a couple of slides around clearing in the pack. One of the biggest risks around that is the lack of comparability between the product set and the specific products that are available to UK clearing houses, which may not be available to EU clearing houses. But also recognising the fact that the market liquidity that sits behind that is a significant differential in many cases. There are other technical issues. So, for example, if you're a Japanese firm, then you also need to have received permission from your JFSA that they have recognised the clearinghouse, and there are, again, inconsistencies in relation to further future Brexit strategies compared to what is currently authorised from regulators such as the JFSA. We're aware that work is ongoing in that regard, so I think, again, it's one to make sure that firms are very, very sensitive to. I'll just make a few more comments around the EU regulators, so moving very quickly on to the ECB before I conclude my piece. And the ECB have been very clear with organisations around their expectations, although I think many firms will recognise that once they've been clear about the overall level of expectation, in some cases they found it difficult to provide specific levels of detail on a firm-by-firm basis, but they have also been very open to have dialogue. The key, I guess, high-level requirements are around the fact that they are absolutely focused on making sure that from a European, that's the EU 27 landscape, there is consistency across the EU, and they have been doing extensive work with the regulators to make sure that, certainly for banking businesses, licensed to provide banking services, there is consistency from each of the EU regulators, because ultimately it's the ECB that signs off the licence permissions. There is also a recognition of the fact that for major securities firms, the direction of travel is that they would ultimately, and there are proposals out there for the expectation that they would ultimately be supervised by the ECB. And certainly when groups have got both banking businesses and securities business, ultimately the proposals on CRP5 for the intermediary parent undertaking would also mean that those businesses are supervised through the ECB. So even if firms, you're not directly supervised at the moment by the ECB, I would certainly encourage everyone to think about what the expectation of the ECB, because that's effectively where we would see the direction of travel. Just a couple of other points at a high level. So self-sufficiency. It's very clear that there is an expectation that EU legal entities are deemed to be self-sufficient. There aren't always very clear guidance as to what that means, but clearly having sufficient ability to the senior executives to know, understand and manage all of the key risks within the entity is critical. Effective governance arrangements and a very clear understanding about how the relationship between the EU 27 legal entity and the other parts of the group, be they in the UK or elsewhere in the world, how those relationships are managed through appropriate service level agreements. And particularly around the need for firms to be able to demonstrate that in the event of a crisis, I think you've got to think about a number of different scenarios for crisis and what they may be, but actually the EU entity has sufficient capability to manage and continue to do some business and run its positions on a reasonably autonomous basis, which may in some cases may mean access to other organisations to effectively manage risk and continue to transact on an ongoing basis in support of its own clients. We've set out on the following page, which is on slide 21, some specific points that we've seen being raised. So the business origination, as well as the support of financial market infrastructure, access, booking models. I think there's a recognition of the fact that many firms' booking models and their original expectations about how they may use booking models, particularly around back-to-back risk transfers, will need to be thought through very carefully, discussed with the regulators, and made sure that they are seen as being sufficiently robust and enable the local legal entity to retain sufficient autonomy and discretion about the risks. I don't think there is a view that it prohibits back-to-back bookings, but I do think it's necessary to think about which trades, how risk is managed, how you provide access to your clients to key products and services, and probably retaining more of the euro-denominated risks within that EU entity. Already touched on some of the intergroup arrangements. Internal governance, I think that's really about the point of making sure you've got sufficient people in the entity, as well as an understanding about how the IT and infrastructure functions and operates. I wasn't proposing to go through the next few slides in detail, but we've got a risk assessment in terms of where we see some of the key challenges. Happy to answer questions on it in due course. But where do we see some of the key risks around these plans? Many firms have got a programme reasonably well established. The regulatory licence process is largely complete. True for many firms, although we are aware of some firms where there are specific and ongoing challenges. Operational readiness, I think, remains an issue, both in terms of, I've mentioned, clients, staff, but also just some of the long-term issues. The ECB has made it clear that they expect firms to have perhaps a day one model with slightly less infrastructure in place, building out to a day two model where it becomes much more robust in the way they're focused on supervising firms. That transition from day one to day two, I think, needs to be thought through very carefully and probably discussed with the regulators. In some cases, the licence application has been predicated on the explicit statement that that day two build out will take place, almost regardless of whether there has been a transition period or not. So very much focusing on thinking about infrastructure. And then we talked about risk management and strategic opportunities. I think that just in conclusion, that one of the overarching observations I would have is that with very, very few exceptions, firms have planned for Brexit on a very tactical basis. They've absolutely focused on making sure that they can continue to provide existing clients with the products and services that they have today. And we want to, we recognise the fact that means that after Brexit, when things start to bed down, many firms will be standing back and thinking actually about the commercial models they put in place. Ultimately, this has been about business prevention, business protection. It's been about incurring costs with no incremental revenue, and I think that we're going to see ongoing changes for quite a long time to come as firms adjust to the new environment. And in some ways, even if the softest Brexit is possible at some point, depending on how the conversations go, I think our view would be that the fact that we've gone through the Brexit process to date means that the world will never revert back to quite the same way it was before, even in the highly unlikely event that Brexit was cancelled.
Andrew, thank you very much. That was an excellent presentation and very wide-ranging and informative. And as you say, the slides will be available afterwards. Just before I hand over to Galina to give a buy-side view, just to remind you, do keep the questions coming. It's a very easy process just to click and put the question in. And those questions we aren't able to follow up in the call itself, we will do separately. So please put your questions in. And then, Galina, handing over to you.
Thank you very much, and good afternoon, everyone. And thank you to AFME for inviting me to speak on the investment management industry's perspective on a no-deal Brexit. By way of introduction, the Investment Association is the trade body that represents and champions UK-based investment managers. Our 250-plus members range from smaller specialist UK boutiques to large global investment managers with a pan-European footprint. And this is important to keep in mind, as different firms, depending on their business model, will be affected by a different degree by Brexit, and more specifically, a no-deal Brexit. The UK is, by a significant margin, Europe's largest asset management centre and the world's second largest after the US, with an international client base that is growing. While the UK's growth as an asset management centre has indeed been helped by advantages like time zone, language, and legal system, it is the UK's expertise and experience that is increasingly sought by clients from around the globe. Collectively, the firms that we represent now manage 7.7 trillion of sterling in assets for savers and investors across the world. 3.1 trillion of this is managed for overseas clients, including 1.8 trillion on behalf of European clients. Building on this success and ensuring the UK remains a world leader for asset management is at the core of our Brexit priorities. And I'm on slide 27. While asset managers have been working on a no-deal contingency plans for a long time and are prepared for this scenario, it remains the least desirable option for our industry and for the millions of people who entrust with their pensions and savings. With just 10 weeks remaining until the UK leaves the EU, uncertainty surrounding whether a withdrawal agreement can be concluded has negatively impacted the flow of capital to British companies. Just to put this in a context, since the Brexit referendum in June 2016, 19.4 billion of sterling has been taken out of UK equities. This trend is continuing, and net outflows in November 2018 were 2.1 billion of sterling. More broadly, uncertainty over Brexit and doubt over the attractiveness of the UK as a global centre for investment longer term are being reflected in the reduction of overseas investors in UK funds. We anticipate a no-deal Brexit will amplify this picture as international capital is redirected out of the UK towards jurisdictions offering greater certainty and growth opportunities. So really, our core Brexit objectives and priorities are simple, and we believe shared across financial services and UK government. To preserve the UK status as attractive and preeminent international centre for financial services, for the UK to successfully negotiate on a technical level with the EU, is to reduce the operational impact on businesses and ensure that firms can continue to offer products and services to clients across Europe. And finally, for our industry to continue to be able to successfully serve savers and investors, as well as companies and projects in need of finance. On slide 28, very briefly, it's a snapshot of where our industry expectations indeed are, and hence our preparation efforts. In October last year, around 38% of surveyed asset management firms expected a no-deal Brexit in which the UK will move to trading on the basis of a World Trade Organization rules with no additional arrangements put in place. And just 21% predicted an orderly exit from the UK from the of the UK from the EU with an agreed transition period. Now, on to slide 29. What are our specific no-deal priorities and asks? To mitigate the worst effects of a possible no-deal Brexit, there are three things that we believe UK government must do in the coming weeks to help our members continue to serve savers and investors across the globe. Protect delegation by concluding regulatory cooperation agreements. This is our first and foremost priority. The timely conclusions of regulatory cooperation agreements between the FCA and its EU 27 counterparts needed to allow delegation to the UK under EU UCITS, AFME and MiFID directives are the biggest priority for our industry. The global norm of delegation has allowed the UK to grow into the world's second largest asset management center. As I pointed out earlier, we estimate that nearly 40% of all assets under management in the UK are from overseas clients, and this is critical to preserve. In a no-deal Brexit, without these agreements, there will be no legal basis permitting the continuation of existing delegation models to the UK from EU clients, or indeed allowing EU 27 national competent authorities to approve new delegation arrangements to the UK. Whilst we understand that discussions regarding these agreements are well underway, firms are under intense pressure from both their clients and EU regulators to relocate portfolio management functions to either within the EU or other third countries with these arrangements already in place, such as the US, Singapore and Hong Kong. It is therefore essential for UK and European authorities to keep the market informed of progress towards concluding these agreements. So firms and critically their clients can be confident delegation will continue in a no-deal Brexit. Second priority for our industry is maintaining the ability for EEA domiciled funds to access the UK market. Today, UK savers and investors are able to choose from over 10,000 different funds. Over 7,000 of these are EEA UCITS are passported into the UK under Section 264 of FSMA, and about 3,500 are UK domicile funds. This range of choice encourages innovation and competition in the market, the economies of scale to help reduce costs, and allow for greater diversification and risk management strategies to be employed that are of the interest of both savers and investors, as well as the firms that are serving them. If a no-deal Brexit, this choice has the potential to fall by nearly 70%, and access for UK savers and investors to be very much limited to accessing just funds domiciled in the UK. This picture is even more serious when we consider the potential availability of specialist fund products. For example, although ETF funds are key building blocks of many UK domiciled funds, only 4 ETFs are domiciled in the UK compared with more than 1,600 in the European Economic Area. In this context, we very much welcome the commitment by UK government to establish a temporary permissions regime for inbound firms and funds in the event of a no-deal Brexit. This regime is now in place and has stopped costly and unnecessary actions by firms until the final status of withdrawal agreement is known, and avoids the risk of disruption caused by a no-deal Brexit for fund managers. Longer term, however, the process for allowing inward marketing to continue to the UK must be reviewed. We therefore welcome the government's recognition that the current process is not fit for purpose, and they will review the relevant legislation, which is Section 272 of Financial Services Market Act. When they do this, the focus must be on establishing an efficient regime that recognizes the important investor protections afforded by EEA UCITS funds, whilst balancing the needs of the regulator in carrying out its statutory duties. Finally, safeguarding access to market infrastructure is indeed a priority that we share across financial services. Our focus on this recognizes very much that asset managers benefit greatly from close proximity with banks and the market infrastructure needed to complete trades, hedge against fluctuations in foreign exchange, and meet clearing obligations. UK and EU capital markets are highly integrated, and with the UK's strong position in share trading and over-the-counter derivatives supported by a critical mass of investment firms and investors, either located in the UK or accessible from the UK. This has helped to sustain deep pools of liquidity, ensure an efficient and well-functioning capital raising and trading activity across all asset classes, which then in turn helps ultimately to keep costs low for individual savers and investors. We therefore very much have welcomed the commitment from the European Commission to grant temporary equivalence for UK-based central counterparty clearing houses of up to 12 months. Andrew has already covered these points in his presentation, but we support further efforts in this direction. Now on to slide 30. This is self-explanatory, but I wanted to share it with participants in today's webinar, as it is the closest we currently are to a formal confirmation by the authorities that regulatory cooperation agreement will be in place in a no-deal Brexit scenario. Concluding this agreement in a purposeful and transparent manner, as I've already said, will avoid irreversible relocation action by firms in the coming weeks. While each firm has its own risk appetite concerning delegation, these public statements taken together, we believe, confirm to firms and clients of the UK asset management industry that there should be confidence that the UK will indeed benefit from a delegation in a post-Brexit world. Finally, on slide 31, a little more practical reflection on what could possibly happen, or rather already is happening. As I stated earlier, asset managers have long been planning for all possible Brexit outcomes. However, in the absence of legal certainty, many firms have already had to action some of their contingency plans. Of the 29 IA members that have made public announcements of such plans, 17 have established a new presence in Dublin, 10 in Luxembourg, with the remainder establishing new offices in Amsterdam, Frankfurt and Brussels. A further 15 are still considering precisely where they will relocate specific functions. Our analysis of member licensing arrangements indicates that this could grow to over 60 should firms suddenly lose access to their MiFID passport, with further 30 UCITS management companies also potentially needing to relocate to within the EU. While most moves so far have involved local hires, firms are increasingly encouraged to locate senior roles such as head of sales and head of risks within the EU to meet substance requirements. Indeed, according to the chart that we've got on this slide and a study that was made in October 2018 by PwC, we may be in for a deliberate change in corporate structures as a result of a no-deal Brexit. 42% of respondents were already considering moving their sales and marketing teams, with compliance functions at 19% and portfolio management functions at 17%. With that, I will draw our industry's reflections on impact and preparation for no-deal Brexit to conclusion and look forward to hear if there are any specific questions in the audience that we can address with some further detail today.
Thank you so much, Galina, for bringing to life the issues and concern from the buy-side perspective. We have indeed had a number of questions coming in. I'm not sure we'll be able to get through them all, but I'm going to throw out a few to start, and then there may, in fact, be some other issues you want to come back to. So just a couple. There's been a question whether the panel can comment on the LSE's lack of recognition affecting EU banks' ability to participate in the LSE. There's also been a question on CCPs, a quite specific one. Is LCH SA planning on extending its products offer to reach LCH's limit as one? And then giving a question on research. How will research distribution be affected when the UK leaves the EU? I don't know, Andrew, whether you want to think about 1 and 2, but Galina, I know you may wish to respond on the research question, because obviously that's a fundamental issue for the buy side.
Of course, research provisions and how they operate was a big priority and focus area for us at the Investment Association in the lead up of MiFID coming into effect. MiFID being one of the big regulatory reforms that we as an industry have gone through most recently. MiFID has now come into effect, but we continue to work alongside our members of how best they could implement these provisions. The US aspect, just to remind the audience in particular, was an intriguing one because we did have a very much difference of regulatory rules between Europe and US. which was indeed promptly addressed by regulatory authorities, and the SEC offering a temporary no-action relief, so the implementation of the research provisions could go in line with what MiFID requires. We're now focusing on what happens in the future, because this is a temporary no-action relief, and regardless of Brexit, the focus would have been there as we work with US authorities to resolve how the market develops, but also how we continue to be able to stay compliant with MiFID. In a post-Brexit world, there is a particular aspect which the no-action relief is indeed phrased in MiFID terms. So we are engaging with our members, working with the authorities to see if we can continue to benefit from the no-action relief as rewarded by the SEC in a post-Brexit world. So I hope that addresses the question. Much more detail to come as we work through it as an industry, both buy side and sell side, but also with the regulatory authorities in the UK and in the US. There is a Brexit aspect, but to remind everyone, there is very much a fundamental aspect of how this operates in Europe versus US.
Thank you. I don't know, Andrew, did you want to comment on either the LSC or the LCH question?
Well, I'm more than happy to talk about the topic. I can't specifically comment on the individual plans of those two organisations. But I think that the point about venues and the exchange is quite clear, that effectively, because of the way that the regulation is framed and share trading obligations, you would as an EU entity, you can't transact on a UK exchange unless there is an equivalence determination. So it's the equivalence that would need to be sorted out. And at this point in time, the EU authorities have not yet done that. So I think that's very much part of the future regulatory landscape that we need to understand how it's going to unfold. The point that I did highlight was the fact that if there is a transition period, then the political agreement did highlight the fact that there would be equivalence determinations before the 30th of June 2020, which would be 6 months ahead of the end of the transitional period. So it sort of is in the realms of, if there's a deal, then you would expect things can be sorted. If we end up with a hard Brexit, then I think we are in a territory where that creates some specific issues. With regard to clearing, the challenge or challenges around clearing are rather complicated, because it's not just whether one clearinghouse or another clearinghouse can actually have the product set, which clearly there is a difference between the UK product availability and EU product availability. There are also question marks around market liquidity, whether you could actually put the trades with the CCP, and also one particular challenge which many EU firms face is, I guess, their existing exposure to an individual CCP. And to move an exposure to a CCP, you effectively need to trade out of that exposure and then trade it back into a different CCP. Again, depending on which way the market liquidity is moving, your exposure, even if there is liquidity in the products you would like to trade into or out of, that process is going to be rather expensive. And CCPs tend to operate most efficiently in markets of highest liquidity. So, indeed, even if there were a replica product set, would the cost of doing business be the same across one jurisdiction versus another jurisdiction? Evidence suggests it wouldn't be. So there are going to be complications and costs regardless of how these things unfold.
Thank you. We just had a question on MiFIR reporting, asking whether it's possible to clarify how trade and transaction reporting will work from the perspective of UK firms if onboarded into UK law. In other words, if an in-scope security is listed in the EEA but not in the UK, will it not be reportable under UK rules? Quite a specific question, but just any initial reactions from our expert panellists?
I mean, I think we'd need to look at the specific details, but effectively the product set would, and at the NICIN level, will be defined in the UK and the EU. On day one, I would have thought those rule sets would be identical. The products would be identical, so I would expect that if it's going to be reportable in the EU, it will be reportable in the UK.
And then a question saying, is it possible, I've been reading about the possibility of a smooth, hard Brexit, which I think means the possibility of the UK leaving the EU without a deal at the end of March, but still having some sort of implementation period. I mean, Andrew, is that something you've heard about? Do you think it's realistic?
An interesting question and a nice idea. Unfortunately, I think not. It was very clear in the text of the withdrawal agreement, which was effectively agreed by both sides, that you either have a deal, which includes the withdrawal agreement and the political commitment on future relationships, or you don't. So if we end up with a hard Brexit, I think that means that you would end the relationship as it currently stands on the 29th of March. I don't see any options for that. The only debate that's being had is whether the EU could extend Article 50. That would need to be a request from the UK government, and then unanimously agreed by all 27 member states that was appropriate. But I think there have been a number of political statements made over the course of the last week or so, which is that there is no appetite on behalf of Europe to extend if it is simply deferring a hard Brexit.
Galina, would you like to comment?
Very short comment on this. In some ways, we are seeing efforts and certain arrangements being put in place to achieve that smooth, no deal, hard Brexit. And an example of that will be the temporary permissions regime, which we now have, that is providing that sort of temporary way of allowing business to continue as usual in the lead up to the new world.
Question here, Galina, about the slide about the functions that are considering moving. The question is, I've been reading that it may be the fund management industry is thinking of moving from London to Paris. Is that the case? And if so, and maybe this is one of you, Andrew, if that's the case, is it more likely that banks will leave London to be in Paris to serve their fund management clients? Galina, do you want to comment on that?
I was quite specific, actually, in terms of the public announcements that our members have made and the actual presence, new presence they're establishing. I talked about the cities, just to remind the audience of the 29 have made announcements, 17 have now established new presence in Dublin, 10 in Luxembourg, and the remainder establishing offices in Amsterdam, Frankfurt, and Brussels. Paris is indeed a city that I am sure is looking at how to attract further business. But in terms of going by the hard data, by the announcements that we have, the engagement that we have heard from the institutions we represent, these are the cities that I want.
Thank you. And Andrew, through the prism of what I might describe as the sell side, what are you picking up in terms of anecdotal and other evidence about location moves?
Yeah, I mean, I think most of the locations which have already been identified by firms is sort of now, baked into their plans. Typically, firms have moved to locations where they already had a presence or already had an entity. And as was mentioned earlier, that would include Dublin, Paris, Frankfurt, Amsterdam, Luxembourg, and a small handful of others. We haven't seen a consistent picture of one location emerging as a future dominant centre of gravity. And I think it's also clear that just the sheer scale of the broad integrated set of financial services that you see in London, that at this stage is not looking, I don't see any evidence that that's going to be replicated anytime soon in any one of these other locations.
Okay, just conscious we're coming into the last few minutes. Question here about, given one of the possibilities still remains no Brexit, is it possible that firms could unwind their plans that they have been having to make in advance of Brexit? Andrew, what's your feeling on that?
I sort of said at the conclusion of my opening comments, the fact that I think the world has now changed it to some degree irreversibly. A number of firms, I think, have taken the opportunity to look at their geographical footprint, and whilst they would in many cases see London as being the home for their EMEA business, they've also seen some attractiveness about a degree of geographical diversity across Europe. We also know that some firms have now taken steps in terms of regulatory licenses. They may well have injected some capital. They may well have relocated some people. That was a costly thing to do in the first place. You're not going to reverse those changes overnight. And I think that regardless, I think what we've seen over the course of the last 2-3 years is a change in the political volatility across Europe. And I think that firms will be quite reluctant do things which don't provide them with some inbuilt contingency in terms of their future business.
Hello, this might be one for you, Oliver Miller, our Managing Director of Brexit. Which cliff edge risk are AFME members most concerned about in light of a hard Brexit?
So I think Andrew's referred to a bit, and also Galina, the clearing, and now that has been, we hope, sort of largely addressed through this temporary equivalence regime. I think that we continue to be concerned around a number of other cliff edge risks. I'd probably say continuity of the existing uncleared derivatives is one of the areas where, although we've seen the Commission saying they're not going to take any action, we are seeing a number of member states now coming forward with legislation or proposals that may allow the continued performance of certain life cycle events on existing derivatives contracts. So that's an area that we're continuing to focus on to try and get more clarity as to the approach that member states will be taking to that issue.
And David McCarthy, perhaps I can turn to you. What would you sort of identify as the single greatest concern from the Investment Association members' point of view in respect to cliff edge?
I think if you asked me this question in September last year, it would have been delegation and cooperation agreements. We've seen since then a number of announcements from the Commission, ESMA, individual regulators that these MOUs are being negotiated and should be in place in case of a no deal. I would say now our biggest concern is around trading and access to market infrastructure. The European Commission was very clear in its announcements about CCPs and CSDs that was about as far as they were prepared to go. And now it is up to firms to figure out how they're going to execute trades in the future.
Thank you very much. One probably final question, which I think we probably answered along the way, is the future of financial regulation passporting regime. I think Andrew has a pretty clear answer, isn't it, in light of what we've said so far?
I think that the clear message is that passporting exists within the EU, and if you're not in the EU, you do not have passporting.
Good. Well, we're coming towards the top of the hour. I'm just going to check to see whether there are any last questions that have come in. Perhaps I could just take the remaining 2 minutes because we've covered an awful lot of territory in the last 57 minutes. Maybe, Andrew Galina, just to kind of summarise, if it's possible, just what would be your kind of key piece of advice for member firms and others listening to this call about preparing for a hard Brexit? And that's probably a difficult thing to summarise, but just if you could put your finger on it each and then we can conclude.
Yeah, I think planning for a hard Brexit is really, the continuation of plans which have already been in place for many firms, recognising that there are costs and there are costs which you might want to avoid in the event of not having a hard Brexit. So I think that it's also keeping in mind the optionality you may have, but recognising the fact that it's potential optionality only if there's an agreement.
And Galina, is that the same perspective from the buy side?
I very much echo those comments. It's the least desirable option, but the one that we are preparing for. Preparation is well underway. It has been happening for many months. Plans are being executed, as we've talked about here today. And with uncertainty continuing to surrounding what the conclusion of this is, firms just continue to move ahead with their plans. So very much echoing all the remarks we have made here today.
Well, indeed, and thank you all very much. As I said at the outset of my piece, the mantra has to be planning for the worst whilst hoping for the best. And as I also said at the outset, these are really unprecedented times politically in the UK. The combination of the deadline coming down the track together with a very difficult parliamentary environment, both for the government, but also for those seeking to see some clarity on Brexit. So I do hope that this has been helpful to those of you who've been able to dial in. We will, as we've said, make the slides available. We will try and get back to those of you who had questions that weren't answered. And if there are other questions that have emerged, do please send them through. So can I finish by thanking all the participants on this call and thank you for dialing in, and please do enjoy the rest of the day. Thank you.